Hey everyone, and welcome to The Explainer. I am so excited to jump into this with you today. We're going to tackle something that is literally foundational to building wealth. We're going to master the single, absolutely critical skill that separates total beginners from the truly smart, resilient investors. You hear this word thrown around all the time in the finance world, but today, we're actually going to break it down. We're demystifying diversification. So I want you to picture this. You've worked incredibly hard for your money, right? You've saved, you've sacrificed, and you finally have this substantial chunk of wealth built up. And then you make a decision. You take every single dollar of those life savings and you drop it into one single investment. Maybe it's that one wildly popular tech stock everyone's talking about, or a single piece of real estate. Your entire financial future is riding on that one single choice. But then the market turns. Suddenly, without any warning at all, that specific investment just crashes. Boom. Just like that, because you had absolutely no safety net, your entire wealth is gone, evaporated in a matter of hours. It's a complete financial disaster. You're literally back to square one, all because of a single point of failure.
Okay, let's dive into this. Section 1, the single investment trap.
Betting everything on one asset is a massive trap. It's just human psychology, right? We naturally want to chase those quick returns. But let's look at the contrast here. The bad way is taking $1,000 and throwing it all into one stock. It's basically a beginner's stressful gamble. If that stock drops by 50%, well, your total wealth just dropped 50%. But the smart way? That involves spreading that exact same $1,000 across multiple, completely different assets. This isn't just about reducing your potential for loss. It's about building a calculated, mathematical safety net around your hard-earned money. And this brilliantly illustrates exactly how that works. Instead of one really vulnerable slice, the smart way builds a pie. Let's take that same $1,000. We put 300 in stocks for growth, 300 in gold, which has historically been a great store of value, 200 in bonds for some solid stability, and 200 in cash so you have immediate liquidity. Now, if the stock market takes a sudden hit and that stock piece shrinks, your gold or your bonds might actually go up to compensate. The pieces balance each other out to keep your overall wealth totally safe. Think of it like a plate of food. If you sit down to dinner every single night and eat literally nothing but white rice, eventually you're gonna get sick. It's incredibly unhealthy because you're missing all those essential nutrients. A healthy body absolutely requires a balanced diet, proteins, greens, complex carbs. Well, your financial portfolio is exactly the same. A balanced financial diet is absolutely essential for your long-term health and wealth. Section 2, what is diversification? So here is the golden rule. Diversification means spreading your money across different investments to reduce risk. I really want you to lock that in your mind. It is not about maximizing your gains to some crazy, reckless degree. It's your ultimate shield against market volatility. Instead of putting everything in one place, you deliberately spread it out. Now, what's really interesting about this next part, Section 3, why it protects you. Beyond just the raw math, this approach gives you structural and psychological safety. It basically breaks down into 3 core benefits. Number 1 is risk control. If one investment fails, the others step up and protect you because they aren't linked together. When one asset zigs, the other might zag. Number 2 is stable growth. And this is fascinating. Different assets boom at totally different times. Stocks might surge during a strong economy, but gold often spikes during a crisis, while bonds just kind of stay steady. And number 3, which is probably the most underrated, is peace of mind. When you're diversified, you just have less stress. And less stress means you aren't making emotional, panic-selling mistakes when the market drops. Let's move on and see how this builds in Section 4, 3 ways to diversify. The very first layer is asset diversification. This is all about spreading your money across completely different asset classes. So we're talking about putting some money in the stock market, some in bonds, some in precious metals like gold, and maybe some real estate. Because these are entirely different financial vehicles, they just don't react to world events in the exact same way. You're never reliant on just one single type of market to survive. The second layer is sector diversification. Now we're zooming in a bit. Let's say you're investing in stocks. You do not want all of your stocks to be in just one industry. You want to spread them across tech, banking, pharmaceuticals, and so on. Why? Well, imagine a massive new regulation hits the tech industry and causes a localized crash. It doesn't ruin your entire portfolio because your banking and healthcare stocks are still holding strong. And the third layer is geographic diversification. You've really got to push beyond your own borders. If you only invest in your home country, you are 100% dependent on that single country's economy and politics. By spreading your investments out into international markets, places like the USA, India, Europe, you're securing true worldwide protection for your wealth.
Section 5. Smart Investing Strategy.
Now for the mastery part. How do we actually put this all together without falling into the common traps? The biggest beginner mistake I see is this false illusion of safety. Someone will come up to me and say, hey, I own 5 different stocks. I'm totally diversified. But then you look at their portfolio and all 5 of those stocks are in the exact same sector. Like they're all social media tech companies. Actually, wait, no, that is totally wrong. If the tech sector takes a hit, all 5 of those stocks are going down together. Your risk is still incredibly high because that diversification is only an illusion.
So here is your master checklist for a truly smart strategy. Step 1, invest in different asset types, just like we discussed. Step 2, choose different industries and sectors. Step 3, and definitely pay attention to this one, don't over-diversify. If you own hundreds and hundreds of tiny investments, it just creates a massive headache and makes it impossible to track your progress. We're looking for balance here, not chaos. And step 4, review your portfolio regularly just to make sure your balances haven't drifted too far off course.
So the crucial point here is captured beautifully in this quote. You don't need to be right every time. You just need to avoid big losses. I mean, think about how profound that is. Smart investing isn't about treating the stock market like a casino and hoping you strike it rich. It's about playing really, really excellent defense. It's about surviving the bad times so you're actually still in the game to benefit from the good times.
And this is a proven mindset. We constantly hear that wealthy, highly successful people don't depend on just one single source of income, right? They build multiple streams of income so that if one dries up, they're completely fine. Well, your investment portfolio requires the exact same philosophy. You absolutely must build multiple streams of financial protection. Which brings us to the final thought I want to leave you with today. Take a hard look at your own financial plate right now. Be completely honest with yourself. Are you currently building a single point of failure that could wipe you out? Or are you taking the smart path, diversifying your assets, and building multiple, resilient streams of protection? The choice is totally up to you, but now you've got the knowledge to make the right one. Thank you so much for joining me on this explainer, and I'll catch you next time.